Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is our weekly technical analysis of Chicago wheat and Chicago corn. I'll start with Chicago wheat. So let's do a quick recap from some of my previous commentaries. The first pattern to look at is the well-telegraphed early March to early June sideways triangle. It's not a great example, but it has merit. The primary target in the 953 area was achieved in June. However, target X1, the harder to reach secondary target, is still live, and that's in the 700 area. The second pattern is to regard the February 2022 to date action as a big letter M, a big M pattern. By using the more conservative high from May in this gave an already achieved primary target in the 866 area, but still has a secondary harder to achieve target X4 in the 715 area alive. Thus we have two primary targets achieved and two secondary potential harder to achieve targets still operational below the market. The most recent activity saw the leg down from the big M pattern, which originally started in May, ease off in early July and head lower, though at a reduced speed. This caused the development of a July to early September bear channel, currently 718 to 800, which calmed the market down quite well, though with a bearish tinge. However, that only lasted until late August when, with the approach from above of the declining short medium moving average, currently 818, the market hesitatingly broke up above the upper bear channel line, and then last week broke determinedly above both the upper bear channel line and the short medium moving average. Now prices continue higher, but yesterday ran into a combination of two 50% Fibonacci lines. The December 2017 to March 2022 move at 887 and the May 2019 to March 22 move at 891, plus the neckline, currently at 887, of the December 2021 to January 2022 immediate reversing head and shoulders pattern. All these halted and turned the tide lower yesterday with a bearish engulfing pattern, the beginnings of a further move lower today. The question now is whether the move lower is the resurgence of the earlier bearish incentive or not. I suspect it may not be. You see, since late August we have started to form yet another pattern. I know this is getting more complex by the day, but we nevertheless have a smaller ascending wedge pattern, and it is this that will be tackling the previously mentioned overhead resistances. Additionally, a little above, we have yet further resistances in the form of the 50% Fibonacci line of the September 2019 to March 22 move at 908, plus the, for the moment, flatlining long moving average, currently 926. Additionally, the descending medium moving average, currently at 940. These resistances will likely not be so easy to breach or break than the earlier ones. Yet the market still seems willing to give it a try up there. This all makes for an interesting market in the next few days, as a seemingly strong bullish force meets seemingly strong resistances. At the moment, I'd keep a close eye on that ascending wedge pattern, as that may well be the key. Two final thoughts. Firstly, will the medium moving average and long moving average make a dead cross? This is a legitimate question, but it depends very much on whether the long moving average moves lower or not. At the moment, it is still looking sideways. Secondly, what will become of the previously mentioned targets X1 and X4? The primary targets for their related patterns already filled. Should these two secondary targets be retired? I personally would look for any move over the long moving average may well mean that, a retirement. If that happens, then we could look at the action since early July as a version of a V bottom with all its opportunities and pitfalls. Overall, watch and see. Chicago corn. Last time I gave 4 factors to consider here. Specifically, about the recent reactionary move higher. Firstly, and at the time I suspected at the time to be at least the least of these four. And that is the reverse head and shoulders pattern over July and early August. I was not happy about it at the time, but I vowed to make a note of it, especially the neckline currently at 665. Well, since then, this pattern has certainly borne fruit. The primary target at 695 was reached this week, and we now have only the harder to reach secondary target X1 in the 714 area. Secondly was the short medium moving average, currently 630 even. On a cursory examination, it looked like early to mid-August saw this pushing back on a rise. It was acting as resistance on a rise. But by late August, the market had punched up right through it. And this moving average is currently not a factor in the market. The third factor is twofold. Part one was the 50% Fibonacci line of September 2021 to April 22 move at 661. Part two is the slowly rising long moving average, currently 676. Now the 50% Fibonacci line was broken with a move higher and is now support. The long moving average, well, there's a lot going on with the long moving average. You see, after a few attempts, the market broke up over the rising long moving average, and for this week so far has seen the market completely above it, but barely. This one requires really close watching, as together with the declining medium moving average, currently 680, and the rising short moving average, currently 673, well, these three are actually zeroing in on each other, and there is a chance or opportunity, depending on how you look at it, to be created by these three even in the next few days, so watch carefully. Finally, there was then the possible July to date ascending wedge pattern, currently at 648 even to 699 even. Personally, I found this last time to be the most elegant of all the four I've spoken about. That being said, at that time we only had 2 touches per side. Well, this pattern has since matured, and we have more than 2 touches on the upper side, even with a temporary breach which seems to have repaired itself. Above all, we are still within this pattern, and it is still a good one. So what has happened since last time that has impacted this market? For this, I draw your attention to the overhead neckline, currently at 697, of the March to June head and shoulders top, the pattern that caused the big move lower that finished in July. This is now acting as resistance on this week's moves higher, and is really the only thing that is capping a rise up to that target X1. So I'm sorry to add this to your workload, but this neckline also needs close attention. Otherwise, we'll have to start looking at the 50% Fibonacci line at 661 again. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright ZD Tofpik and ADM Investor Services International Limited. And here comes the final bit.